So welcome to a new Clearstream virtual session on the ETF markets. As a key infrastructure supporting ETF markets globally, Clearstream is keen to engage with market participants on all the latest topics. My colleague, Catherine, works in our ETF product management area, and I'm Allan. I work in our ETF relationship management team. Now, in this session, we will be looking back at 2020 and what were the defining moments of the ETF market, but also seeing how this will influence the ETF markets in 2021. Now, to discuss this topic, we're happy to have with us today Anthony Martin from RIZE and Antoine Lesne from SPDR. Antoine Lesne is head of SPDR ETF strategy and research for EMEA. Anthony Martin is co-founder of RIZE ETF. So welcome to you both. We're very happy that you can be here with us. I would like to start, if I may, with the first question. Now, this would be for both of you, Anthony and Antoine. Now, we all remember the market volatility episode in March of last year, of course, which particularly affected the fixed income markets and fixed income mutual funds. Now, this accelerated institutional adoption of fixed income ETFs. Now, what is your view? And perhaps Antoine, more than Anthony, you may have actually a direct view on that, but what is your view on the episode itself? And do you think this made a permanent impact on the ETF market? Again, perhaps making reference here to the specific investor profile, i.e. institutionals. Antoine, we'll listen to you, of course, as well, Anthony.
Thank you very much, Allan, and it's great to be with you today. So obviously 2020 was, I think, a landmark event. We've talked about the 2008 crisis that kind of like gave a real boost to the adoption of equity ETFs, and in the fixed income ETF market, we believe that 2020 marked a big step in history, and that we were living history at the time. And one of the key takeaway for that is it showed the resiliency of the broad ETF ecosystem in fixed income. So we'll come back to which type of investors are no more keen to using fixed income ETFs. But clearly, for the past decade or so, sitting on a panel like this one or many other different types of conferences, being a fixed income ETF provider and marketer to some extent, I was always in the role that, oh, you have never been tested by a crisis. The next crisis will be very bad on your high yield ETFs, and so forth and so on. And I think 2020 was an occasion to show that actually ETFs did play a role. They did help manage liquidity during a relatively challenging moment to some extent, but we managed to get a lot of liquidity into the market, both in and out of the market, actually, in a very, I would say, ordered way. And that's been very clear. And the advantage is maybe that the ETF was providing over the underlying bond market, is that you had a price to trade on. You might not like the price, but you had a price to trade on in those moments. And speaking with some insurers, for example, and some large institutional investors, they said, well, at least even in the Govie market, in the Euro Govie market, we got a price on your Euro Govie ETF. We couldn't find a bid from sometimes if we wanted to sell on some of our bonds in the underlying market. So that's really something that was important for us. The result is that it has actually been, bringing more investors from that kind of very institutional investment profile, or very institutional investors profile, to the ETF or to the fixed income ETF market altogether. 2020 was the best year ever in terms of global fixed income ETF flows in the US and globally, and it was the second best year in the European market, with shy of 40 billion euros of inflows last year. So that was quite an impressive change in dynamic. There's been a number of reports as well that have been written by the Financial Times, the Wall Street Journals, and some of the more critics of the market, and they've all seen that this market has actually gone through the crisis and come out stronger.
Thank you very much, Antoine, for your views. So price discovery, liquidity, the institutional profile there appearing more forcefully. I'd like to go back to Anthony, if I may, and if you're still online.
Yeah, so
yeah, now on these points, though, these crucial points, price discovery, liquidity, I mean, what was your view there? What did you, I suppose, take away from that infamous episode, Anthony?
Yeah, so thanks again for having me, Alan. I think firstly, what I'd probably say, what I'd add is, so we don't do fixed income ETFs, but historically we've managed, emerging market fixed income. And I think what we saw is, the ETF industry comes under a lot of criticism. And I think that's largely because you're seeing massively increasing market share, and there's naturally, the mutual fund world, I think would largely hope to see some issues with ETFs, and every time we have a crisis, they seem to come through very well. So they have been tested, they have come through well. I think you sometimes get some of the negative media attention on liquidity, but again, every time, the ETFs succeed. And I think one area I would point out is, in particular with fixed income, around sort of March time last year, is on the issue of premiums and discounts. There were one or two articles going around talking about issues with significant discounts for certain bond ETFs out there, and how mutual funds aren't affected. But I think that's it's quite misleading, and so that's probably one issue I'd just touch upon. And I won't go into too much detail on it, but on the premiums and discounts, it's important to understand that the NAV is typically using a price source, a predetermined price source, that aims to establish a fair value for a bond during, during distressed times. This often can be a lot higher than the actual price of when you sell the bond. So what this means is that NAVs can be not representative of the probable realization value of those equities, whereas the actual exchange value is. So it's not necessarily the case that you're seeing a massive discount on exchange or underpricing. It's more that the exchange price potentially is actually the real value of what it costs to sell those ETFs. And this is something that is in mutual funds and ETFs, where you'll have a price source that will take whatever it is, BVAL or Reuters price, and it'll say, right, here's the price of the bond, but actually when you go and sell it, it's a lot less than that. So that's something that ETF NAVs and mutual fund NAVs will have exactly in common. And the process of trading on exchange gives investors really what the fair value is. And it's not the case that you can go and redeem at NAV and get a big premium, because in practice, when you do that redemption, you will be paying for the the cost differential between the NAV price and the actual price. In a mutual fund, that'll be in the form of swing pricing. So that was just one of the things that was highlighted in a few articles I read last year, which was, I think, a little bit misleading, comparing mutual funds and ETFs. And ETFs really do highlight that intraday ability to buy and sell at fair value. It is a significant benefit.
Anthony, yes, indeed. I mean, certainly at our end, we're at pains very often to explain the differences, complex differences between mutual funds and ETFs. I think you've put your finger quite rightly on one of those. I'll let Catherine continue on one of our second topics there, which I think is close to your heart, Anthony.
Yes, during 2020, we saw a strong growth in thematic ETFs and mega trends. Anthony, what's your feeling on this growth, and maybe also on the short and long-term performance of these products?
We've seen a tremendous growth, and I think that's not just recently, but for a number of years now in thematic ETFs. And at RIZE, we specialize exclusively in thematic ETFs. So we see a number of drivers for this growth to continue. But firstly, sort of recognizing what thematics are. So thematics, they recognize long-term drivers of value creation in areas that aren't covered by the traditional sectors that investors have historically chosen. So it's effectively investing into these industries and trends of the future. So real long-term investing, and they resonate with investors of all types, because typically these are themes that are present in people's everyday lives. So it's very clear when you look at these themes out there, you don't have to do a huge amount of explaining to get the point across to investors and to see the potential of a lot of this growth. And you've also got, what's interesting with thematics is this intersection with sustainability. So these themes that are expected to be prevalent for decades to come, often, and not in every thematic case, obviously, but often they have naturally sustainable characteristics, because the global trend of the future is towards sustainability, and that's exactly what thematics are typically trying to capture. So, for example, sustainable food or clean energy, these are things that are naturally fit in the thematic world and also intersect with sustainability. So investing into the future, which thematic investing is all about, will naturally have that intersection with sustainability. I think it's still a young marketplace for thematics, but the numbers are growing rapidly. We built our first, back with ETF Securities, our first the robotics ETF back in 2014, and back then we remember a lot of the salespeople, weren't necessarily very pro having that ETF, thought it was too niche, it wouldn't sell, and then in 2017 it took $1 billion in 1 year. So I think it's something that's certainly growing, and it's much more accepted at the moment. And there's, it's attracting not just a big increase in the number of funds available, but also a huge increase in the assets that it's attracting. And we're seeing investors increase their allocations into thematics, from much smaller proportions a number of years ago. But I think what's also important is seeing a big increase in retail investment. So Europe's typically been, some of the older statistics, around 5 to 10% retail participation into ETFs, and close to 50% in the US. And I think we're starting to see that really grow in Europe, and thematics are a big part of helping that drive an increased interest in retail appetite for ETFs as well. And then, there has been, performance in thematics has been good. I think there's been 1 or 2 articles, criticizing or pointing out, maybe a minority of funds that haven't done necessarily that well. But I think a Morningstar report showed last year 33 out of 36 European thematic ETFs outperformed MSCI World. Now we wouldn't look at a 1 year time period. For us, these are very long-term trends and long-term investments, and should be viewed over that longer term. But we've certainly seen strong performance in the thematics we've been involved in.
Thank you very much, Anthony. I mean, this is a very insightful. I think you've explained very well, in fact, that the thematics play well with these more viable, more long-term approaches. I think Catherine will want to perhaps pick up on that.
More on ESG. The rise of ESG ETFs is a clear trend today. Antoine, what are your views on tracking and composition challenges for ESG ETFs?
They are definitely in fashion. I'd say that if we're looking back, it's been 2 to 3 years that you started to see the first ETFs in the equity space, and maybe a bit more recently in fixed income space. There's 2 things. The first thing is, obviously, we've talked about thematics. We've talked about choosing an exposure to some specific trend. When it comes to ESG, it's a bit different. There's different shades of the way you could implement ESG in your portfolio. For us, and especially in the ETF space, it's often akin to indexing. It's not only indexing. You've got some actively managed ETFs as well, but the vast majority of the exposures currently are in index-based strategies. And in that context, the question about tracking is how do you make your index? Because we're going to track that index. So if it's an exclusion in equities or a best-in-class approach, and that's going to be the same thing in fixed income as well. Sometimes, however, we've just talked about thematics, and Anthony was making an interesting comment about the fact that different types of investors are also coming to this to the ETF markets through thematics, because they may be less benchmark oriented. But for the large, institutional type of investor who may be more benchmark oriented, the question of including ESG in their asset allocation may drive or may create some tracking error. So when you're building the exposure, and it's important to understand exactly how the exposure is met. You are going to maybe voluntarily or involuntarily create some tracking error versus your strategic asset allocation. And that's what you need to first look at as an investor. Understand whether a number of exclusions is going to generate a tracking error of maybe 50 basis points or 100 basis points, or if it's actually going to create 3, 4, 5%, like an active strategy to some extent in your asset allocation. And in equity space, you might tolerate a little bit more tracking error than you would tolerate in fixed income. And so the key question afterwards is, how do you implement that? So at SPDR and in other firms, there's different ways to do that. For us, we've gone in fixed income in particular, we've gone with a way to have exclusion. So I would say the standard ticks the box exclusion, excluding controversies, tobacco, thermal coal, and this kind of, or kind of like UN Global Compact offenders. But at the same time, looking for a best-in-class approach, only taking the ones which have a better ESG score. And maybe we can talk about the ESG score afterwards together with Anthony, maybe if he's got a view. But on this side is just try to find the best in class thanks to the ESG score. And when you're thinking about the remaining exposure, you might actually have only 40% of the parent benchmark of the initial universe. So what you've got to do is sometimes to put some constraints to make sure that you do not change the drivers of performance profile or drivers of risk profile, which would be in fixed income, the interest rate sensitivity and the credit spread, or how much you're going to be compensated for the risk you're taking. And that's what we're trying to do. So ESG starts with a good objective, and then you need to make sure that you align it to what you want to have in your portfolio. But if I can leave you on a small stat, just looking at the fixed income ETF market in Europe, of the 10 new fixed income ETFs that have been launched so far this year, up to February 2021, 9 of them were ESG ETFs. So it's also a new trend for product developments on top of a big trend for inflows.
Indeed, very insightful. Thank you very much, Antoine. Now, both, I mean, Anthony and Antoine, while we're still on the subject of ESG, and in terms of the opportunities and the number that you just gave, Antoine, is very interesting there. Do you see, and I'm now going to turn to sort of regulation, perhaps Anthony, you would have a view on that. Do you see things like SFDR opening opportunities there? And I think that's, again, back to the whole debate, is regulation more of an opportunity than a constraint? And if you work with the opportunity, really, it does open up new avenues for business. So ESG, SFDR, would you say there's a link and a beneficial link there? Anthony or Antoine, I mean, whoever would first want to answer.
Sure, happy to go first. Yeah, so I think SFDR is going to have a huge impact on the industry. I think it's one of the major pieces of regulation to come out, and it impacts not just asset managers, but also it's the buy and the sell side that it impacts. So I think it's certainly significant. It's going to involve a huge amount of work for asset managers as well. But I think overall it's going to be very beneficial. And this has come out today, but it's really going to be over the next couple of years that we're going to see a lot of the impacts of it. So I think really one of the big differences is now you've got to classify your funds into different categories, whether it's dark green, light green, unsustainable. And I think, asset managers haven't been primarily focused on classifying their funds necessarily. We've talked about ESG scores previously, but I think, what this really does is with detailed level 2 regulation, you're going to start to see that asset managers are spending more time now on how to comply with these classifications. And you can't just say, yes, I'm a dark green fund, very sustainable, ticking a lot of the boxes, without actually doing a huge amount of work and being being accountable for that. So this kind of links on to what you've seen over the last few years with marketing. Most companies are coming out with marketing very ESG focused and everything else, and there's been a bit of a disconnect between some of the marketing you might see and what's actually happening in the investment process. So when you're marketing ESG, sustainability, impact, according to certain changes in investor appetites, what this regulation ensures is that is now linked directly to the investment process and the portfolios and the companies that you're managing and buying and selling, which is something that we haven't seen before. And I think this to an extent, standardization is also useful. That there hasn't been a standardization of ESG really before. There's lots of companies offering different scores, and everyone has a different view. And which parts do you see as the most relevant? Is it the environment, sustainable governance? Environment's clearly a big focus for a lot of people. And I think this is where you had a lot of greenwashing historically, which now I think this regulation will help put a lot of meat on the bone and help investors see what they're actually investing in. So I do see it as beneficial across the board, and I think there's obligations on these asset managers to ensure that there's a common standard, and to ensure that what they're saying is sometimes in the investment objective it has to be specified, and there's real scrutiny. There's compliance elements now to know what you're marketing about these funds. So I think it's a good thing. I think it helps to standardize it, and I think it'll help investors really differentiate between different types of funds and look beyond some of the historic marketing that they might have seen.
Thank you very much, Anthony. I mean, what I'm hearing there is definitely a vote of confidence. I hear, and you are certainly confirming that this will very much help that part of the industry. Expressions like greenwashing, dark and light green, I think all help us, sort of visualize what is at stake here. Turning back to Antoine, a similar vote of confidence, perhaps on your side as well.
Yeah, definitely. I think it's been as I've said, in the ETF market, we've seen a growth of the number of funds that are provided with an ESG label. The key thing is obviously when you've got an expansion or a flurry of different shades of ESG, it's important for the investor to also find its way through it. So regulation tends to be a good tailwind for flows. We've seen at the beginning of the year a continuation of that good level of inflows in the both equities and fixed income ETFs with an ESG flavor in Europe. There's been a small pause waiting for this SFDR regulation to be implemented and for everyone to actually start, giving a label or what we call articles, so Article 8 or Article 9, which tend to be relatively darker green. One, maybe Article 9 having a bit more focus on the impact itself, whether an Article 8 looking at the involvement of the or the investment process in the way you're managing the exposure. But clearly, this is regulation in the driving seat, and this is going to hopefully bring some clarity for the end investor in order to. I don't know if we've got to say green as well, because ESG is just beyond green. There's a bit more than there's environment, and that could be some climate type strategies. But you also have the social impact and the governance impact, which are also very important element for I would call sound risk management, and that's probably why also ESG has got a relatively good tailwind, because it's helping have sometimes over the longer run a better risk-adjusted return. That's important in our fiduciary duty to make sure that we bring that to investors.
So we have about reached the end of our panel discussions. Just to wrap up on the topics that we have covered today, we are basically all confirmed and convinced that ETFs are definitely a resilient, robust product and continue to be so. They are the perfect asset class to quickly and efficiently capture themed investor appetites. ESG is a long-standing part of the ETF offer and a topic which ETFs continue to further develop. So we would like now to thank our two panelists for the very good insights, Anthony Martin of RIZE and Antoine Lesne of SPDR. We very much hope that you enjoy this virtual session. Please look out for our next session coming soon, where we will be covering other ETF market-related topics. Thank you.
Thank you very much indeed.